Welcome to the deep dive. Today, we're really diving deep into one of those truly iconic global companies, the Coca-Cola Company, ticker KO, of course.
Yeah, it's a classic. For decades, it's been seen as this benchmark for defensiveness, stability in almost any investment portfolio.
Exactly. And our sources today, they're really focusing on a deep fundamental analysis. We want to treat Coca-Cola not just as a familiar brand, but as this kind of financial fortress.
That's the goal. Our mission here is to look, well, beyond the sort of fuzzy nostalgia and really analyze why this company offers that durable mix of, let's say, modest but consistent growth, operational stability.
And that reliable income, right? The growing dividends are key for long-term investors.
Absolutely. Reliable, growing income for the long haul. That's the core of it.
And when we talk about a global staple, the numbers are just staggering. It's one thing to say, oh, Coke is everywhere,
Right.
but it's another thing entirely to really wrap your head around the scale. Their products,
Mhm.
over 200 countries,
Pretty much the entire globe, yeah.
Mm.
It's unparalleled reach.
that scale, that distribution network, it's really the first pillar of their economic mode, isn't it?
It absolutely is. And consider this number. They reach about 33 million customer outlets worldwide.
33 million. Just think about that. Every little corner store, gas stations, roadside stands,
They've got a product there. Somehow they managed to get it there.
and their physical footprint backs that up too. We're talking something like 14 million branded cold drink units, coolers, vending machines.
14 million. Essentially mini billboards or mini stores that they control placement of.
That physical presence, that control, it's so critical, isn't it? Especially for impulse buys.
Oh, completely. That cooler sitting right there at the checkout.
Mm-hmm.
It's a constant, silent salesman, often right at the perfect spot, the point of sale.
Driving those high-margin, immediate consumption purchases.
Exactly. It's real hard power just built right into their business model. It's quite something.
So yeah, the core investment case really hangs on that incredible economic moat. But the big transformation we need to track here, maybe the most important takeaway from this deep dive, is that aggressive strategic shift they're making. The company is actively, consciously moving away from just being the carbonated soft drink, the CSD giant,
Right, the 20th century image.
to becoming this diversified, total beverage company. And understanding that pivot, well, it's essential for figuring out their future relevance. Okay, so let's maybe unpack that shift a bit by looking at the industry itself. We're talking about the global non-alcoholic beverage market, and it is just gigantic.
Gigantic is the word. Estimates put it around, what, $1.3 trillion for 2024?
$1.3 trillion. Wow.
And it's not just the sheer size that matters here. It's the nature of it. This market is remarkably resilient. It's non-cyclical.
Meaning,
Well, whether the economy is booming or in a downturn, people still drink liquids. They still buy that daily coffee or juice or soda.
right, basic needs almost.
Exactly. That stability gives it this inherent defensive quality. Very few other consumer goods sectors can really match that.
Okay, so it's huge and stable, but you wouldn't call it stagnant, right? What are the growth forecasts looking like?
No, definitely not stagnant. Future growth projections are actually pretty robust. The forecasts suggest a compound annual growth rate, a CAGR, that could be anywhere between, say, 5.1% and maybe even 7.6% over the next decade or so.
7.6%. That's significant for such a massive base.
It really is. If it hits that upper end, you could see the market balloon to almost $2.9 trillion by the early 2030s.
Wow. And what's driving that? It can't just be population growth, can it?
No, not just that. It's really driven by a couple of major ongoing secular shifts in what people want to drink.
And that's the key, isn't it? That secular shift. This is kind of the aha moment for the whole industry. What are consumers really demanding now that maybe they weren't asking for, say, 10 years ago?
Yeah, it really centers almost entirely on health, wellness, and this idea of efficacy. Just
Yes.
to drink, do something.
Okay, health and wellness. That means less sugar, right?
Primarily, yes.
Yeah.
The global focus on obesity, diabetes, general health awareness, it means there's this accelerating demand for low sugar and zero sugar options. That's a fundamental change. People are actively trying to avoid simple sugars.
But it's not just about avoiding the bad stuff. It's also seeking out the good stuff.
Exactly right. That's the other side of the coin. You have this huge growth in what we call functional beverages,
Functional meaning.
meaning consumers don't just want refreshment anymore. They often want a drink that does something positive for them. So products fortified with specific ingredients. Think probiotics for gut health, maybe adaptogens for stress, added vitamins, antioxidants.
So Coke has to become like a health supplement company almost.
In a way, yes,
Hmm.
it forces every major player, Coke included, to think like a functional food company, not just a seller of, sugary water.
Interesting. And we're also seeing this play out in premiumization too, aren't we? People seem willing to pay more.
They absolutely are. This is a definite shift away from just bulk buying towards, let's call it, quality consumption.
Okay.
People are willing to spend significantly more for, say, unique flavors or perceived higher quality ingredients or maybe more sophisticated sourcing stories.
Can you give an example?
Sure. Look at the incredible success of Topo Chico mineral water, which Coke acquired. Or think about their Fairlife milk brand, ultra-filtered high-protein milk that commands a real premium in the dairy case.
Right, I've seen that. It's definitely pricier.
It is. And consumers don't see these as just basic commodities. They're positioned and perceived as premium lifestyle choices.
Okay, so they've got these defenses, this fortress. But even a fortress needs to find new territory, right?
Yeah.
Where is Coke focusing its efforts to find that, next bit of volume growth?
Well, the real long-term engine for volume growth, geographically speaking, seems concentrated in the Asia-Pacific region.
Asia Pacific. Why there specifically?
You've got a combination of factors: rising disposable incomes, pretty rapid urbanization, a growing middle class that's increasingly adopting Western-style consumption habits.
Makes sense.
And these emerging markets, broadly, are the crucial long-term frontier because the penetration of commercial beverages, things you buy, versus, say, tap water, is still relatively low compared to places like US or Europe. There's just more room to grow.
Got it. Now let's talk competition. The non-alcoholic beverage space. It's often called an oligopoly, right? A few big players dominate.
That's a fair description. Coca-Cola is the clear global leader. Estimates put their share at around 40% of the total non-alcoholic ready-to-drink market, NARD, as it's known.
40%. Okay, who's next?
PepsiCo is right behind them, typically holding around 30% of that NARD market. And then Keurig Dr. Pepper is the significant number 3, especially strong in North America, where they have about 10% share.
So a very concentrated top tier.
Very much so.
Yeah.
It's a tight, powerful group at the top.
We used to just call this the Cola Wars. Coke versus Pepsi. But that feels like a massive oversimplification now, doesn't it?
Oh, completely. That term really doesn't capture the complexity of the battleground today. It's more like a multi-front war fought across dozens of highly specialized categories.
So it's not just about cola anymore.
Not at all. I mean, yes, the traditional carbonated soft drink segment, CSDs, that's still a massive mature cash cow for them. And Coke's dominance there is, well, it's profound.
How dominant.
In the crucial U.S. market, estimates for 2023 had Coke holding something like a 69% share of CSDs.
69%. Wow, that dwarfs Pepsi.
Absolutely. PepsiCo is around 27%. So that core CSD business, it throws off enormous amounts of cash flow. That's the war chest, basically.
But the growth, the future revenue,
Yeah.
that's happening in other segments where specialists often lead, right? Like energy drinks.
Exactly. Energy drinks are a perfect example. That segment's famously dominated by the two specialists, Red Bull and Monster Beverage.
What are their shares like?
Red Bull holds roughly 44% market share, globally estimated, and Monster's got about 33.4%. They're the big two.
And where does Coke fit in there? Don't they have their own energy drinks?
They do, but their main play, strategically, is through their distribution partnership with Monster. They also own a significant equity stake in Monster Beverage.
Ah.
That relationship gives Coke an estimated 20% value share in the energy category without having to directly beat Red Bull or Monster head-to-head.
Wait a second, though. Relying on an equity stake in a competitor like Monster, doesn't that kind of signal a failure for Coke to innovate effectively in that really high-growth energy space themselves?
That's a really sharp question. And yes, it's a key point of analysis.
I mean, how secure is that relationship if Monster ever decides, we don't need Coke's distribution anymore?
It absolutely signals that, yes, their own organic innovation efforts in that very specific, very niche, high-energy category, well, they struggle. Their attempt with Coke Energy, for instance, didn't really take off.
Right, I remember that. It disappeared pretty quickly.
It did. So the Monster relationship, you could see it as a brilliant defensive and offensive move. It guarantees them exposure to that high growth.
Without the risk.
Without incurring all the huge R&D risk
Yeah.
and the massive marketing spend you need to try and dislodge those established incumbents. It's pragmatic.
So it's a high-class problem, maybe,
Yeah.
but there is a partnership risk baked in there.
There's always some partnership risk, yes. But the agreements are very deeply integrated, very robust. It's more a pragmatic recognition that sometimes leveraging your scale is best done through partnership rather than trying to fight every battle directly. They acknowledge they couldn't easily win that one organically.
Okay. That complexity, it definitely increases the execution challenge for Coke, but like you said, it gives them crucial diversification away from the traditional CSDs, which face those secular headwinds we talked about.
Exactly. It lets them participate in the growth without carrying all the operational weight themselves.
Yeah, me too.
Right. Now, let's pivot to what really sets Coke apart, that competitive moat. This is the fundamental reason the stock often trades at a premium valuation.
The moat. And our sources suggest it's one of maybe the widest and deepest economic moats anywhere in the global economy.
That's the argument, yeah. It's built on this kind of self-reinforcing system, multiple layers protecting its ability to generate cash flow year after year.
And it really starts with the brand, right? The brand equity. That's the psychological part of the moat.
Absolutely. Coca-Cola has, I think the number is 30 brands now that each generate over $1 billion in annual retail sales. $30 billion brands.
Incredible. And the main Coca-Cola brand itself.
The value assigned to just the Coca-Cola brand name alone is around $35 billion.
$35 billion. How does that compare to, say, Pepsi?
Pepsi's brand value is estimated closer to $20.2 billion. Still huge, obviously, but substantially less than Coke's. That difference isn't just noise, it's significant.
And that massive brand loyalty, that translates into real power, doesn't it? Like psychological switching costs for us as consumers.
It's enormous. Think about it. You walk into a store, you're faced with this wall of choices. But the immediate recognition of that red logo, the feeling of habit, the maybe subconscious association with happiness or nostalgia.
It drives the purchase before you even really think about it.
Exactly.
Yeah.
Often you're buying the brand, the feeling, not just the liquid inside. And that sticky habitual demand that gives them this almost unrivaled ability to manage their pricing.
Which we definitely saw play out during that recent inflationary spike, right?
Oh, we certainly did. We'll get more into that.
Yeah.
But yeah, that loyalty is key.
Okay, brand is huge. But the real financial wizardry, maybe,
Yeah.
the thing that separates Coke from a typical manufacturing company, that's the business structure, isn't it? The Coca-Cola system.
Yes, what analysts often call the capital light business model.
Capital light. Explain that.
Well, the refranchising strategy, which they executed mostly over the last decade, was just a masterstroke. It fundamentally changed the company's DNA. Think of Coca-Cola, the parent company KO, less as a beverage manufacturer now and more like a pure-play intellectual property and marketing firm.
Okay.
KO focuses almost exclusively on the high-margin part, making and selling the concentrate, the syrup, the secret formula. That's the capital light piece. Their IP, their recipe, is the engine.
Right. So they make the valuable goo.
Pretty much. And then the hard part, the really capital-intensive work, bottling it, packaging it, maintaining the suites of trucks, managing all the local distribution labor.
That gets pushed onto someone else.
Exactly. That's all handled by their network of about 200 independent bottling partners around the world. These are separate companies, often very large and sophisticated themselves. Coke deliberately shed those capital-heavy, lower-margin assets off its own balance sheet.
And that's why their profit margins expanded so much.
That shift is the direct, quantifiable reason. Before the big refranchising push, Coke's operating margins were typically in the low 20% range.
Yeah.
Post-refranchising, we've seen them sustain levels in the high 20s, even touching the low 30% range during that 2022-2024 period.
Wow, that's a huge jump in profitability.
It is. They made a conscious strategic trade. They intentionally gave up billions in top-line revenue.
By selling the bottling operations.
Right. In exchange for a significant permanent boost in bottom-line profitability and capital efficiency. Less revenue, but much higher quality revenue.
And that immense brand loyalty we talked about, that feeds directly into pricing power, right? Which, as you mentioned, got seriously tested with all the inflation we saw from 2022 through 2024.
Absolutely. That period was a real stress test. Their input costs, things like sugar, aluminum for cans, freight costs, they were skyrocketing.
Yeah, everything went up.
But Coke was able to implement pretty broad-based price increases and critically make them stick.
Yeah.
They largely offset those rising costs.
Which tells you what?
It tells you that consumers, by and large, simply wouldn't switch away from the brand even when they had to pay a bit more. That ability to protect your profit margins during inflationary times, that's the absolute hallmark of a powerful, unshakable economic moat.
Okay, but this pricing power, it's not just them randomly hiking prices across the board, is it? It sounds more sophisticated than that.
Oh, much more. It's not a blunt instrument at all. It's highly sophisticated, very data-driven, and that brings us to one of their core capabilities today, something called revenue growth management, or RGM.
RGM, revenue growth management, what is that exactly?
RGM is maybe one of the most important sort of secret weapons Coca-Cola has now. It really elevates them beyond just simple brand management.
Okay.
It's this highly complex, data-intensive approach to optimizing the entire brand price package architecture, as they call it.
Brand price package. Give us a practical example. How does RGM work in the real world? Because it sounds like complex software.
It involves complex software, yes, but the results are very visible. Instead of just chasing total volume sold, RGM focuses on maximizing the profit and revenue from each transaction, each occasion.
Okay, so not just selling more Coke, but making more money each time you sell one.
Precisely. Imagine you're at a gas station at 3 p.m. You want a cold drink, right? That's an impulse buy.
Yep.
RGM data tells Coke that the highest profit margin comes from selling a premium-priced, single, perfectly chilled bottle in that specific convenience store setting. People will pay for the convenience and the immediate refreshment.
Okay.
But then think about a budget-conscious family doing their big weekly shop at a supermarket on Saturday morning. They need value.
Right, they'll buy a multi-pack.
Exactly.
Yeah.
So RGM allows Coke to sell affordable, large multi-packs in that channel. It lets them surgically adjust the price, the package size, even the specific placement on the shelf, based on the store type, the time of day, the shopper's likely mission.
All driven by data from those 33 million outlets.
Precisely. They maximize profit from the exact same liquid by selling it differently, smartly, in millions of different contexts.
That level of sophistication, it ties right into what feels like the most forward-looking part of their strategy, building this new digital moat.
Yes, they're actively leveraging that enormous physical network, the 33 million customer touchpoints, the 14 million coolers, and turning it into a proprietary data gathering network.
So the physical presence feeds the digital intelligence.
Exactly. That physical footprint is being digitized. Now, those coolers, they aren't just chilling drinks anymore. Increasingly, they're becoming smart, connected vending machines or digital interaction points with retailers.
Sending data back to HQ.
Constantly feeding data back. What's selling, when, at what price, even potentially inventory levels. This creates a powerful self-reinforcing advantage. It's a proprietary feedback loop that competitors, without that same global physical scale, simply can't replicate.
And you see this digital shift reflected in their spending priorities too, right? It's not just TV ads anymore.
Not at all. Their spending on digital media has climbed dramatically. It went from under 30% of their total marketing budget back in 2019
Okay.
to approximately 65% in 2024. That's a massive reallocation.
And where's that digital money going?
It's going into highly targeted, personalized digital marketing, e-commerce platforms, and importantly, feeding that data back into the RGM system and their innovation pipeline.
So better data leads to smarter decisions.
Incredibly precise decisions about, what niche product should we maybe test in this specific region? What's the absolute optimal price point here? When should we promote it? This interconnected system, the brand pull, the ubiquitous physical presence, amplified by this data layer that's the modern moat that really separates them.
Okay, let's shift gears and look at the financials. We have to address that U-shaped revenue path over the last decade or so, because if you just glance at the top line, you might get the wrong idea about the company's health.
Yeah, context is absolutely crucial here. Revenue actually fell quite significantly. It went from about $34.3 billion in 2015 down to a low point of $34.3 billion in 2018.
Which looks bad on the surface.
It looks like the business is shrinking, right?
Mm.
But that decline wasn't a sign of some operational failure. It was the intended result. It was engineered.
Engineered how?
It was the direct outcome of that refranchising strategy we just talked about. They were deliberately shedding billions of dollars in lower margin revenue that came from the bottling operations they sold off.
Ah, okay. So it was a planned financial diet, basically, designed to improve quality over just sheer size.
Exactly. Improve profitability, improve capital efficiency, and the proof is in the pudding, or rather the profit lines.
You're right, because profitability held up remarkably well during that revenue dip.
It did. Their gross profit margins stayed incredibly stable, consistently hovering in that super efficient 59% to 61% range throughout the transition.
Which shows what?
It proves that their pricing power on the core concentrate, the syrup, is almost absolute. They control the valuable part.
And the real strategic win shows up in net income.
That's where you really see it. Net income actually grew consistently through that period of shrinking revenue. It increased from $7.4 billion back in 2015 to $10.6 billion in 2024. They successfully streamlined the business to generate more profit from less, lower quality revenue.
Okay, let's talk cash flow. Coke is famous for being a prodigious, predictable, free cash flow generator, right? Usually averaging over $8 billion a year.
Highly predictable, yes. That's a key part of the appeal.
But looking at the 2024 numbers, the reported free cash flow, FCF, came in quite a bit lower, around $4.8 billion. That seems like a significant drop. What's going on there?
Yeah, that $4.8 billion figure definitely needs some explanation. It's not really indicative of the underlying operational cash generation strength. You have to look past that headline number.
Why? What hit it?
It was heavily impacted by a couple of major one-off, non-recurring cash outflows during that specific year.
Like what?
Well, first, there was a very large cash deposit related to a complex, long-running tax dispute with the IRS here in the U.S. That's essentially money set aside for a legal issue. It's not a flaw in the business operations.
Okay, the big legal provision. What else?
Second, they finalized a large contingent consideration payment related to the Fairlife Milk acquisition. Remember how successful that's been?
Right, the premium milk brand.
So this was basically the final installment payment for acquiring and successfully scaling that high-growth premium brand. It was a known, planned outlay related to his successful M&A deal.
So these are big, lumpy, one-time items that just happen to hit in the same reporting year, skewing that annual FCF number downwards.
Precisely. The underlying cash-generating machine itself is still running very efficiently.
How do we know that?
You look at their FCF conversion ratio. That's the percentage of net income that turns into free cash flow. And their target, which they generally hit, is still incredibly high in the 90% to 95% range.
Why is it so high?
Again, it comes back to that capital-light business model. Because they don't own the bottling plants and trucks, they require very little ongoing capital expenditure, CapEx, to maintain their high margins. That inherently makes the cash generation robust and highly predictable once you smooth out these unusual large one-off payments.
And that efficiency, that capital light structure, it leads to really superior returns for shareholders, doesn't it? Looking at metrics like ROIC and ROE.
Absolutely. The numbers are quite impressive. Return on invested capital, or ROIC, was around 16.0% in 2024. And return on equity, ROE, was a staggering 44.76%.
44% ROE, that's huge.
It is. You typically only see numbers like that in maybe software companies or highly specialized pharma biotech firms with unique IP.
And again, that's because they've outsourced the capital-heavy stuff.
Exactly. The vast majority of the capital-intensive work, the assets, sit on the bottler's balance sheets, not Coke's. So KO itself is incredibly efficient at deploying the capital it does have and generating massive returns on it.
Okay. And then for income investors, the dividend. That's really a cornerstone of the whole investment case, isn't it?
It really is. They hold that very prestigious title of Dividend King.
Meaning
they've increased their dividend payout to shareholders for, I believe it's 64 consecutive years now?
64 years straight, through everything.
Through every major economic crisis, recession, war, market crash, since the early 1960s. That track record is extraordinary.
What was the dividend in 2024? And how fast is it growing?
The dividend in 2024 was $1.94 per share. And the growth rate has been very consistent, typically around 4% per year.
And is that sustainable? What's the payout ratio like?
Crucially, yes, it looks very sustainable. It's supported by a quite manageable payout ratio, usually in the 65% to 75% range of earnings. That means they're not stretching too far to pay it. There's still cash left over.
So for a defensive blue chip stock, that combination of, unparalleled stability plus consistent income growth, that's exceptionally rare and valuable.
It's a very powerful combination, especially in uncertain economic times.
Okay, let's shift now to strategic growth initiatives. We really have to give credit to the current CEO, James Quincy. He seems to be the main architect behind this total beverage company vision, and he's the one who really drove and executed that massive refranchising initiative.
Yeah, he's definitely put his stamp on the company since taking over. And he made some pretty bold, maybe even tough choices early on, particularly around managing the brand portfolio.
What did he do there?
Well, he basically took a hard look at all the hundreds of brands they own globally and decided to take a knife to it, cut out the dead wood.
How many brands did they cut?
The decision was made to discontinue approximately 200 underperforming brands. They were sometimes called zombie brands internally.
Zombie brands.
Yeah,
Because they were just shuffling along, not really growing.
exactly. These 200 brands represented roughly half of the company's total brand count, believe it or not. But they generated a negligible amount of revenue, maybe only 1 or 2% of the total. Yet they still consumed resources, management attention, marketing focus.
So cutting them wasn't just about tidying up, it was a strategic move.
Absolutely. It was a crucial strategic reallocation. By shedding the resources tied up in those zombie brands, they freed up capital, freed up talent, freed up management focus.
To concentrate on the areas with real growth potential.
Precisely. To focus squarely on high-growth, high-margin categories and driving meaningful innovation. The strategy now seems laser-focused on 3 main growth pillars.
Okay, what's the first pillar?
The first is premiumization. We touched on this earlier, but the results they're getting here are pretty undeniable.
And the success of Fairlife Milk is the poster child for that, right?
It really is a fantastic case study. Fairlife was apparently the single top dollar contributing brand across all categories in U.S. retail in the first quarter of 2025.
Wow, #1 overall, not just in beverages.
#1 overall contributor to dollar growth, yeah. It shows that Coke's massive infrastructure can successfully acquire a premium, specialized brand in this case, high-protein filtered dairy, and then scale it up rapidly using their distribution muscle.
What other examples of premiumization are there?
Well, they also acquired Body Armor to significantly strengthen their position in the premium sports hydration segment. That puts them in direct competition with Gatorade, but really aiming at that higher-priced, more premium end of the market.
Okay, so premiumization is pillar 1. What's number 2?
Pillar 2 is innovation, and this ties directly back to that huge health and wellness trend we discussed. They know they have to innovate constantly.
And this is where they need to be nimble, right? Even as a giant company.
Exactly. They have to act fast. Look at the launch in 2024 of Simply Pop. That's a prebiotic soda.
Prebiotic soda, interesting.
It demonstrates their very intentional, pretty rapid pivot into the functional beverage space. They know they can't just sit back and wait for CSDs to slowly fade. They have to proactively invent and shape the future of beverage consumption.
So they're investing heavily in new types of drinks, new formats.
Definitely. New formats, new ingredients, products designed to capture a share of all the different times people drink something during the day, whether that's for energy in the morning, hydration midday, maybe relaxation in the evening. They want a product for every occasion.
Makes sense.
Okay, pillar 3.
The third major growth runway is emerging markets. We mentioned Asia Pacific, but this is the ultimate long-term volume driver globally.
Right, because penetration is still low.
It represents this vast, largely untapped opportunity. But it requires a very specific, very tailored strategy. You can't just sell the same products the same way as you do in Atlanta or London.
How big is that opportunity?
Well, consider this. In the regions that are home to roughly 80% of the world's population, commercial beverages, the stuff you buy, still only account for about 30% of total liquid intake.
Only 30%. What's the other 70%? Mostly non-commercial stuff. Tap water, maybe homemade drinks, teas, things like that. So for every one commercial drink Coke or its competitors sell, there are potentially 2 other consumption moments they could capture. That's a massive addressable market over the long term.
Okay, so how does a giant company like Coke tailor its strategy to win in, say, a rural village in India versus a booming city like Ho Chi Minh City in Vietnam? They must need different approaches.
They absolutely do. It involves this sort of sophisticated, 2-pronged approach, focusing on affordability and building infrastructure.
Affordability first. How do they manage that? Coke isn't always cheap.
They drive down the price per serving by using really smart packaging. Offering smaller single-serve formats is key. Think mini cans, smaller peaky plastic bottles.
Right, so you can buy just one small drink for a low price point.
Exactly. This makes the product accessible even to lower-income consumers, maybe daily wage earners, who are budgeting very carefully. It's about building that consumption habit without requiring people to buy a big, expensive multi-pack.
Okay, that's affordability. What about infrastructure? You mean the coolers?
That's a huge part of it, yes.
Yeah.
They, along with their bottling partners, aggressively invest in building out that cold drink infrastructure, placing coolers and vending machines in strategic, high-traffic locations, especially in regions like Asia-Pacific and Latin America.
Why is the cold part so important?
Well, it creates immediate accessibility, obviously, but crucially, especially in hotter climates, it drives cold consumption habits. If the drink isn't chilled and refreshing, the impulse purchase is much less likely. So that infrastructure investment is absolutely essential to unlocking that potential volume growth where penetration is currently low.
Got it. So all these strategic pillars, premiumization, innovation, emerging markets taken together, they underpin management's own long-term financial targets, right?
They do. Management consistently guides the market towards achieving 4 to 6% annual organic revenue growth.
Organic meaning stripping out currency effects and acquisitions.
Exactly. Growth from the core business. And alongside that, they target 7 to 9% annual growth in comparable currency-neutral earnings per share, EPS.
And hitting those targets consistently would validate this whole strategy.
Absolutely. That guidance really validates their belief in what they call our all-weather strategy. They're trying to skillfully balance these different growth levers, affordability and infrastructure in developing markets versus premiumization and sophisticated RGM in mature markets. The goal is a business that performs reliably, delivering that growth, pretty much regardless of which way the broader economic winds are blowing.
Okay, so the bull case, rooted in this transformation and the moat, sounds pretty strong. But we absolutely have to pivot now and be clear about the significant headwinds and risks. No business, not even one with a moat as wide as Coke's, is immune to challenges.
Absolutely not. And the most significant long-term strategic risk, the one that hangs over everything, remains that accelerating global shift away from sugary beverages.
The core CSD business is still hugely profitable, but it's facing that secular decline in demand.
It is. And that underlying headwind is constantly being amplified by direct regulatory pressure. That's a very tangible threat to the CSD cash cow.
You mean sugar taxes?
Exactly. More than 50 countries around the world have now implemented some form of sugar tax on beverages. And the data is pretty clear.
What does the data show? How much impact do these taxes have?
Studies generally show that these taxes tend to reduce sales volume of the taxed sugary drinks by an average of about 15% in the markets where they're implemented.
15%, that's not trivial at all. That's a direct, immediate hit to volume in potentially large markets.
It's significant, yes. So the question becomes, how quickly can Coke adapt? How fast can they reformulate their portfolio to shield future volume growth from that kind of tax hit?
Is the regulation actually helping them adapt in a strange way?
Paradoxically, yes. You could argue it acts as a powerful catalyst. It creates a real sense of urgency, a burning platform that compels the company to accelerate that strategic pivot into low-sugar and zero-sugar options even faster than they might have otherwise.
It forces innovation.
It forces innovation and reformulation at speed, and you see the results. Low and no-sugar products now make up about 29% of their total global volume. That's up significantly from where it was, say, a decade ago.
And they're reformulating the big brands, too.
Yes, proactively. Creating zero-sugar versions of powerhouse brands like Sprite, Fanta, even Coke itself. That ensures they can continue to capture that consumer demand and market share while also potentially avoiding the tax burden in many markets.
Okay, so sugar taxes are a big risk, but also a catalyst. What else? As a huge global company, they must be exposed to macro risks like currency fluctuations.
Hugely exposed. Remember, about 2/3 of their total revenue comes from outside the United States.
2/3? Wow.
Which means that when the U.S. dollar strengthens against other currencies, it creates a significant headwind when they translate those foreign profits back into dollars for reporting.
Can you quantify that impact?
Sure. Just as one example, in the second quarter of 2025, adverse currency movements shaved a substantial 5 percentage points off their comparable EPS growth. 5 points just gone due to FX.
Ouch. So that's not an operational problem? The business didn't do worse, it's just a translation issue.
Exactly. It's a translation effect, but it's a real impact on the reported numbers. And it means management has to dedicate significant financial resources and expertise just to hedging and managing this constant, massive currency risk.
Okay. What about operational risks? Things like input costs.
Right. They're still exposed to commodity price inflation, things like the price of sugar, aluminum for the cans, PE resin for the plastic bottles. Those costs fluctuate and can pressure their cost of goods sold.
And supply chains. Even with the capital light model, they still rely on complex global supply chains, right?
They do. And despite the model, they're not totally immune to disruptions. You might recall back in late 2021, the CEO actually publicly acknowledged they were anticipating sporadic shortages continuing through 2022.
Why was that?
Just due to those lingering global bottlenecks in labor markets and logistics that affected everyone after the pandemic peak. So while Coke probably manages these risks better than most, thanks to their scale and partnerships, even they can't completely isolate themselves from major global supply chain friction.
Makes sense. Okay, one final risk, or maybe it's more of a characteristic, the valuation. We mentioned it trades at a premium.
Yes, that's definitely something investors need to consider.
The market seems to have already priced in a lot of the stability and the success of the transformation that we've been talking about.
That's generally true. The stock typically trades at a premium price to earnings PE ratio, maybe around 23.6x recently,
Mm.
and an enterprise value to EBITDA,
Yeah.
EBITDA multiple around 20.5x. Those are relatively high multiples.
And what does that imply?
It implies that the market has very high expectations baked into the current share price. Investors are paying that premium specifically for the quality, the stability, the reliable income growth.
Which leaves little room for disappointment.
Exactly. It leaves very little margin for error. If Coke were to fail to consistently hit that 4 to 6% organic revenue growth target, for example, or if the execution risks and expanding into new functional beverage categories turn out to be higher than people anticipate, well, the premium valuation could come under pressure.
So the key question for an investor is the market paying too much for that stability and quality, or is the premium genuinely warranted by the business fundamentals?
That is the multi-billion-dollar question, isn't it?
So let's try to synthesize all of this. We've got this incredibly high-quality company trading at a premium price. It's facing some genuine long-term secular headwinds in its biggest, most profitable core business sugary drinks.
Right.
Yet at the same time, it seems to be undergoing a pretty successful, very data-driven strategic transformation into this total beverage company. So why is that valuation premium arguably justified, especially when you compare it to maybe a more diversified peer like PepsiCo?
Yeah, it really comes down to a couple of things.
Yeah.
Structural superiority and pure profitability. Coke's superior scale, that global reach we talked about, combined with that $35 billion brand equity, and critically, that capital-light business structure. All those things together arguably warrant a higher EBITDA multiple.
Higher than Pepsi's. Why? Pepsi is huge, too.
Because Coca-Cola, having strategically offloaded the capital-intensive bottling operations, is now fundamentally a higher margin, less capital-intensive business than PepsiCo, which still owns significant bottling and has a large, lower-margin snacks business too.
So Coke's business model itself is just more profitable pound for pound.
Generally, yes, it results in those superior ROIC and free cash flow conversion numbers we discussed earlier. They are simply more efficient structurally at turning a dollar of revenue into profit and cash flow available for shareholders.
Okay, so the general consensus view then is that KO stock is best thought of as a core defensive portfolio holding. It's designed for stability, not necessarily for explosive growth.
Precisely. It's not a high-growth tech stock or a speculative play. It's historically low beta, usually hovering somewhere between 0.4 and 0.5.
Meaning it moves much less than the overall market.
Exactly. It tends to be much less volatile than the broader market, both on the way up and, importantly, on the way down during corrections or recessions. It's seen as a compounder, an income engine, something designed to dampen overall portfolio risk while providing those reliable, steadily growing dividends.
Okay, so for listeners who might own Coke or are thinking about it and they want to track whether this whole investment thesis is playing out as expected over, say, the next 3 to 5 years, what are the key quantifiable metrics they should really be monitoring?
I boiled it down to 3 critical indicators.
Okay, number 1.
First, keep a close eye on the consistency of that 4 to 6% organic revenue growth figure. If they consistently dip below that range for several quarters, it might suggest that the innovation pipeline or the RGM strategies aren't quite delivering as hoped.
Makes sense.
Yeah.
Number 2.
Second, you want to see continued positive volume growth, particularly in those key emerging markets, specifically Asia Pacific and Latin America. That's the real barometer for whether they're successfully capturing that long-term growth runway. Flat or declining volume there would be a concern.
Got it. And the third metric?
Third, monitor operating margin stability and, ideally, expansion. We need to see them consistently maintain profitability above that key 25% operating margin level. Pushing back towards the high 20s or even 30% range would really validate the ongoing strength of their pricing power and the success of that capital light model. Falling below 25% might signal issues.
Okay, consistency in organic growth, volume growth in emerging markets, and stable to improving operating margins. Those are the key dashboard lights.
Exactly. Those tell you if the core thesis is holding up.
All right, that brings us to our final provocative thought for you, the listener, to maybe mull over. We've talked a lot about Coca-Cola's historic competitive moat.
Yeah, built on that That incredible distribution network, the millions of coolers, and the immensely powerful, nostalgic brand loyalty.
Right, but we've also seen how the company is aggressively trying to transform its competitive edge to modernize it for the 21st century.
The modern edge seems increasingly reliant on that data feedback loop, leveraging those 33 million digital consumer touchpoints, whether it's smart cooler, an e-commerce interaction, or data from a retail partner to inform pricing, product placement, and innovation.
A scale advantage in data that seems pretty unique in the consumer goods industry.
It really might be.
So here's the question for you to ponder. Will Coca-Cola's unparalleled scale in gathering and analyzing this digital consumer data continue to reinforce its dominance? Will it create an enduring analytic advantage that maybe smaller, more specialized, nimble competitors simply can never match?
Or is the alternative true? Will the inherent execution risk in trying to transform such a massive traditional organization into a high-speed innovator, especially in fast-moving categories like functional beverages, will that allow smaller, more agile companies focused on specific niches to successfully chip away at Coke's foundational market share, despite Coke's data advantage?
It's that classic tension, isn't it? Scale versus agility, incumbent versus innovator.
It really is. And the outcome of that ongoing battle will likely define the success and the valuation of this financial fortress for the next generation of investors.